Over the past several weeks, an event has unfolded that has sent tremors through America's financial infrastructure in ways we haven't experienced since the latter stages of the last decade. The tremors are becoming increasingly difficult to ignore. Across the nation, ordinary Americans are discovering that managing their financial obligations has become measurably harder. The numbers tell an alarming story. Household debt has now exceeded $18.3 trillion. That's not a theoretical problem confined to economics textbooks. It's a reality affecting families at kitchen tables across the country, people trying to calculate whether they can afford their next car payment, their next rent check, or their next grocery trip. But here's where the situation takes on an entirely different dimension. In recent weeks, two behemoth corporations, entities that the investment world believed were fundamentally sound, companies bolstered by relationships with major financial institutions, companies that carried credit ratings suggesting they were among the safest bets in the market, experienced a form of collapse so swift and so dramatic that it left seasoned market observers struggling to process what had occurred. These weren't marginal operations or speculative ventures. These were multi-billion-dollar enterprises that appeared, based on every conventional measure, to be financially healthy. One of them carried something that investors consider almost sacred, a AAA credit rating. That rating carries a specific meaning in finance. It's supposed to signal that the investment is essentially risk-free, backed by assets and management so sound that failure seems virtually impossible. And yet, both of these companies unraveled with such velocity that markets experienced genuine shock. Part 1. The first domino falls. Let me walk you through exactly what happened, because understanding the mechanics matters. The first collapse involved a major subprime auto lending operation based in North Texas. To understand why this matters, you need to first understand what a subprime auto lender actually does. These companies specialize in providing vehicle financing to individuals who have damaged credit histories or credit scores considered too risky by conventional banks. They're filling a specific market niche. People who need transportation but lack the credit profile that would qualify them for traditional financing. The business model seems straightforward enough. The company originates loans to these borrowers, charges them interest rates that reflect the elevated risk, and theoretically generates profit. But that's not where this story ends. Here's where financial engineering enters the picture. These lenders take the loans they've originated, sometimes hundreds of thousands of individual car loans, and they bundle them together into packages. These packages are then transformed into securities that can be bought and sold in financial markets. These are called asset-backed securities. The theory is elegant. Investors purchase these bundles, receive regular interest payments as borrowers make their car payments, and both the lender and the investor benefit. On paper, this arrangement looks remarkably stable. The underlying collateral, the actual vehicles, has tangible value. Rating agencies, the institutions responsible for assessing credit risk, examined these securities and applied their highest ratings. That AAA designation flowed out to investors worldwide. Billions of dollars poured into these investments because the rating suggested that the risk had been carefully evaluated and deemed minimal. Then something unexpected happened. In September, the company missed an interest payment. It was a single missed payment, one payment out of thousands that should have been distributed to investors. That one failure to pay triggered something, a recognition that perhaps the underlying assumptions weren't quite as solid as everyone believed. Suddenly, nearly $2 billion in loans that had been considered safe were very much in question. What followed was a cascade of events characteristic of financial stress. Lenders who had extended credit lines to this company began taking defensive positions. Some initiated procedures to recover assets, specifically the vehicles financed by these loans. The Department of Justice initiated an investigation into the company's practices, and the preliminary suggestion was that fraud might have occurred. Not merely poor management or unexpected market conditions, but potentially deliberate misrepresentation. This raises a question that rippled through financial markets. If a company that carried the highest possible credit rating could deteriorate so rapidly, what does that say about the reliability of the entire rating system? More broadly, what does it say about the financial institutions that depend on these ratings to make investment decisions? If the safety mechanisms are flawed, how many other investments in the financial system might be operating under false assumptions about their stability? Part 2. The scale of the crisis. The collapse of this single auto lending operation isn't an isolated incident. It's emblematic of something far larger happening across American households and businesses. Consider the broader context. In 2024, over 1.7 million vehicles were repossessed across the country. That number represents the highest rate of vehicle repossessions in more than a decade. It's not a statistical anomaly. It reflects a pattern. Americans with subprime credit are falling behind on their obligations at accelerating rates. The numbers are stark. Among borrowers with poor credit histories, 6.6% are currently at least 2 months behind on payments. That's a significant delinquency rate. But here's what makes it more concerning. Even borrowers with good credit scores are beginning to miss payments at noticeable rates. This suggests that the problem isn't confined to traditionally risky borrowers. The pressure is affecting people across the credit spectrum. The youngest generation of Americans faces particular pressure. Among Generation Z borrowers, nearly 8% are delinquent on their auto loans. That's not a marginal problem. That's roughly 1 in 12 young adults who are unable to keep current on their vehicle financing. When you consider that vehicles have become increasingly essential for employment in most of America's geography, this delinquency represents a threat to economic stability for millions of households. Why is this happening? The underlying cause is straightforward but devastating. The cost of living in America has reached levels that researchers describe as unsustainable for average households. Access to a basic standard of living has become measurably more difficult to achieve. The numbers illustrate this pressure. The average price for a new vehicle has climbed to approximately $50,000. For someone working at median wage, purchasing a vehicle without financing has become virtually impossible. And financing that vehicle has become substantially more expensive. Interest rates on new car loans are now exceeding 9%. Used vehicles, the more affordable option for lower-income households, carry interest rates around 14%. These rates are substantially higher than they were just a few years ago. Then there's insurance. The cost of auto insurance has jumped 19% in just a single year. Someone purchasing a used vehicle at a subprime rate while also paying dramatically elevated insurance costs faces a financial burden that consumes an outsized portion of their income. The mathematics are simple but brutal. A vehicle that once represented freedom and opportunity, a central part of the American narrative, has become something else, a debt trap. Families now face a stark choice: maintain a vehicle that you need for work and survival, or allocate those resources to food and housing. The mathematics don't work out. There's not enough. So families lean on credit cards, payday loans, subprime auto loans. Debt accumulates faster than income grows. The interest on that debt compounds, and paychecks that are already stretched thin don't reach any further. Part 3. Government policy and the acceleration of crisis. The situation might be manageable if policy interventions were designed to ease the pressure. Instead, analysis suggests that certain policy choices have accelerated the stress. The administration has implemented tariff policies on imports from major trading partners including China, Mexico, and Europe. Economists across the political spectrum have noted that tariffs function as a tax on consumers. The costs of imported goods increase. This includes everything from groceries to automobiles to school supplies. For households already struggling, additional costs at the checkout register and the car dealer are not abstract economic concepts. They're immediate pressures on budgets that lack flexibility. High interest rates, maintained by the Federal Reserve in an effort to control inflation, further compress household finances. When borrowing becomes more expensive, and simultaneously the cost of goods purchased on credit increases, the burden on households intensifies. Additionally, there's been a regulatory shift. The administration has signaled a direction toward reduced regulation of lending institutions. Regulatory constraints that previously limited predatory lending practices have been loosened. This creates an environment where subprime lenders and other high-interest rate lending operations can expand operations with fewer restrictions. For households desperate to finance necessary purchases, this means more aggressive lending products, higher interest rates, and more complex terms. Meanwhile, federal programs designed to provide household financial relief have been curtailed. Student loan payment protections that had provided borrowing households with modified payment terms have been rolled back. This particularly affects younger Americans who are already struggling with vehicle debt while also carrying educational debt. For young households, the pressure is multidirectional and intensifying. Housing has become another flashpoint. Rents and mortgage costs continue to climb while federal assistance programs have been reduced. The social safety net, the institutions designed to provide stability when households face financial stress, has become demonstrably thinner. For millions of Americans, the policy environment is contributing to, rather than alleviating financial stress. Wages aren't keeping pace with cost increases. Debt is becoming harder to service. And the institutional support systems that might cushion the impact have been reduced. Part 4. The second collapse and the broader alarm. Just when financial markets seem to be processing the impact of the auto lending company's failure, another enormous institution faced its own reckoning. First Brands Group was a major supplier to the automotive industry. The company had a substantial balance sheet. Reports suggested it held nearly $1 billion in cash. By conventional measures, it appeared financially resilient. Then, in late September of 2025, the company filed for bankruptcy protection. The liabilities listed in that filing exceeded $10 billion. That's a disparity so large that it immediately raised questions about how the company's financial situation had deteriorated so dramatically. The investigation that followed revealed something particularly unsettling. Significant portions of this debt had been financed through structures that didn't appear on conventional financial statements. Invoice-backed lending arrangements had been used to secure financing in ways that obscured the true extent of the company's obligations. To outside observers and to conventional financial analysis, the company looked healthier than it actually was. This raises a question that extends well beyond First Brands. How many other major corporations are using similar financing structures? How much corporate debt is effectively hidden from view, disguised through financial engineering that technically complies with accounting standards but obscures underlying risk? The significance of First Brands' collapse is that it demonstrated that the problem isn't confined to subprime auto lending. The pressure affecting that sector, the difficulty of managing debt loads, the temptation to use creative financing structures to make obligations less visible, is affecting major industrial corporations as well. Household debt has now reached a record $18.4 trillion. Families are falling behind on automobiles, mortgages, and credit cards. Now, the corporate entities that families depend on for employment and services are themselves imploding under the weight of unsustainable debt. It's a cascade effect. Pressure that originates in household finances transmits upward into the corporate sector. And when corporate entities fail, the consequences flow back down to households that lose employment or services. Part 5. The hidden architecture of financial risk. To understand why these two company collapses matter so much, you need to understand the financial system that enabled them to accumulate so much debt in the first place, and that now faces pressure as a result of their failure. After the financial crisis of 2008, the regulatory environment shifted substantially. Major banks were required to maintain higher capital reserves. Lending standards were tightened. The most aggressive and risky lending practices faced new constraints. For a period, it appeared that the financial system had incorporated lessons from the crisis and adopted more conservative practices. But the demand for credit never disappeared. Companies still needed capital to operate and expand. Investors still sought investment vehicles that offered higher returns than could be achieved through conventional, lower-risk investments. The gap created by reduced bank lending needed to be filled. Into that gap stepped a different category of financial institution non-bank lenders and large asset management firms. Some of these firms have names familiar to financial markets, Apollo, KKR, and others, but they operate outside the regulatory framework that governs traditional banks. These firms began developing increasingly complex financial structures that allowed borrowers to access capital and investors to achieve attractive returns. The structures became progressively more elaborate. Loans were bundled. They were sliced into different tiers based on risk. Different investors would purchase different slices, with some investors taking on higher risk in exchange for higher potential returns, while others accepted lower returns in exchange for greater perceived safety. Ratings agencies blessed these structures with high ratings. Investors, seeking yield in an environment of low interest rates, chased these investments. The risks, however, didn't vanish. They were relocated. They were pushed into corners of the financial system that were less visible, less regulated, and more opaque. The asset-backed securities market, which is supposed to be a mechanism for distributing and managing risk, instead became a vehicle for obscuring it. This market is enormous. The asset-backed securities market in the United States is worth approximately $1.5 trillion. It encompasses not just auto loans, but credit card debt, equipment leases, aircraft leases, and even intellectual property arrangements like music royalties. It has become foundational to how American corporations and consumers access credit. When investors examined the asset-backed securities created from auto loans and other consumer debt, they believed they understood what they were purchasing. The underlying assets, the cars, the equipment, the intellectual property, had value. If borrowers defaulted, these assets could theoretically be recovered and sold. The securities would be backed by real collateral. That theory encountered reality when the auto lending company missed its interest payment. Suddenly it became apparent that ratings don't guarantee stability. Assets can lose value rapidly. Once confidence in a financial structure begins to erode, the entire mechanism can deteriorate quickly. An investor quoted in the Financial Times described the auto lending company's collapse as one of the most severe events in the history of the asset-backed securities market. Consider that statement carefully. A market worth trillions of dollars. One of the worst events ever documented in that market. That's not a statement about a small corner of finance. That's a statement about a mechanism that's central to how modern credit functions. The situation with First Brands added another dimension to this alarm. If companies can use invoice-backed lending to hide billions in obligations, the question becomes unavoidable. How much debt is actually hidden throughout the financial system? How many balance sheets are less healthy than they appear? And when investors and rating agencies don't have accurate information about the actual debt levels of the entities they're evaluating, how reliable are their risk assessments? Part 6. The Contagion Effect. What happens when confidence in a financial mechanism begins to erode? The answer has been demonstrated repeatedly throughout financial history, and it follows a predictable pattern. When lenders become concerned about risk, they tighten lending terms. Credit that was previously available at reasonable rates becomes unavailable or available only at substantially higher cost. When investors become concerned about risk, they begin to sell at losses rather than holding assets they perceive as increasingly dangerous. When companies lose access to credit markets, they face constraints on their ability to operate. This creates a self-reinforcing cycle. As conditions tighten, more entities encounter difficulty. More entities encounter difficulty, more investors flee the market. The more investors flee, the tighter conditions become. The cycle can accelerate surprisingly quickly. There are early indicators that this cycle may have already begun. The asset-backed securities market, which was supposed to distribute risk efficiently through the financial system, now contains question marks about the actual risk embedded in its structures. As those questions proliferate, they generate more caution, which generates more selling pressure, which generates more panic. If this particular market begins to substantially deteriorate, the consequences wouldn't be confined to two companies or to one sector of the financial system. We're discussing a $1.5 trillion infrastructure that is woven through enormous parts of the American economy. Disruption to this market would transmit disruption throughout the financial system and into the broader economy. Households would experience it through reduced access to credit and higher borrowing costs. Companies would experience it through the same pressures. Employment might be affected if companies face capital constraints that force them to reduce operations. The financial stress that currently manifests in missed car payments and growing household debt could transmit into economic stress that affects employment, spending, and investment. Part 7. The Preconditions for Crisis. The question then becomes, how did we reach this point? What conditions have created a situation where a $1.5 trillion financial market is dependent on structures that may not be as safe as investors believed? The roots extend back to the aftermath of the 2008 financial crisis. The crisis demonstrated that conventional assumptions about financial risk had been fundamentally flawed. Banks had believed that housing prices would never decline significantly. Rating agencies had believed that mortgage-backed securities were substantially safer than their actual risk profile. The result was a massive financial crisis that required government intervention and imposed substantial economic damage. In response, regulatory reform was implemented. The Dodd-Frank Act imposed new requirements on banks. Capital reserve requirements were increased. Lending standards were tightened. For a period, it appeared that the financial system was being restructured to prevent a recurrence of such crisis. But the underlying dynamics that created the pre-2008 environment didn't disappear. The desire for higher returns didn't disappear. The willingness to engage in financial engineering to achieve those returns didn't disappear. The optimism about risk, the belief that risks had been mastered and were no longer a serious threat, returned after several years of elevated caution. Simultaneously, regulatory pressure eased in certain areas. The environment became more permissive toward new forms of financing. Asset management firms that weren't traditional banks operated with fewer constraints. The alternative lending market expanded. New financial structures were created and marketed to investors as innovations that distributed risk more effectively. The problem is that distributing risk more effectively isn't the same as eliminating risk. Creating more complex structures isn't the same as creating safer structures. Obtaining a high rating from a rating agency doesn't guarantee that the underlying assumptions are sound. And when those assumptions prove flawed, as they did with the auto lending company when it missed a payment, the entire structure becomes vulnerable. Part 8. The Scale of Household Financial Stress. To fully appreciate the significance of what's occurring in the credit markets, you need to understand the household financial stress that's driving it. Americans across multiple income levels and demographic categories are reporting that their financial situation has become measurably more challenging. Wage growth hasn't kept pace with the cost increases they're experiencing. The gap between income and necessary expenses has compressed. For lower-income households, the pressure is particularly acute. A minimum wage worker faces the same vehicle costs as someone earning 3 times that income. Rent and housing consume increasingly large percentages of household income. Healthcare costs continue to escalate. The combination of these pressures leaves households with reduced flexibility and increased dependence on credit. Even for middle-income households that might have more resources, the situation has become more difficult. A household earning a professional-class income might be managing multiple forms of debt: a mortgage, vehicle loans, student loans, credit card debt. Interest rates on all of these have increased. Meanwhile, housing costs have climbed dramatically in many markets. The combination of higher debt service costs and higher housing costs compresses the available household budget. This is why vehicle repossessions are at decade-high levels. This is why even borrowers with good credit are beginning to miss payments. This is why credit card debt is climbing. Households are reaching the limits of what they can service, and further pressure, higher interest rates, higher insurance costs, higher vehicle prices, pushes them past those limits.